With all the talk of late about negative interest rates and helicopter money, it seems the war on cash is just getting started. With me to discuss is Oliver Davies, author of 1 Month Money. Well, Oliver, first off, what would you say is the fundamental problem, or indeed problems, with our current monetary system?
The system we have to manage it, central banking, is basically central planning. Central bankers are supposed to manipulate interest rates, manipulate asset prices to drive a level of spending that's not too high, it creates inflation, not too low, it creates unemployment. This is basically an impossible task. It doesn't know what these level of interest rates is to drive that magical level of spending. There's so many factors affecting it. Even if they did know these interest rates, it's not clear they have the tools to manipulate financial markets in the way they want to. You know, how much does 500 billion in quantitative easing reduce interest rates by? It might be 0.5% on one day and 1% on another. Central bankers simply don't know what they need to do to keep spending at that level that gives us full employment without too much inflation.
So you've suggested quite a revolutionary fix which makes money expire each month. Talk me through this.
If we had money expiration, we could fix spending at the full employment level. It doesn't change no matter how crazy people are, no matter how greedy or fearful they are. Demand is fixed. There are no business cycles. And what money expiration means is, for you or I as wage earners, we receive our wage at the beginning of the month and that money's on a ticking clock. At the end of the month, if you haven't spent it, or saved it, it disappears. And what this does is fix aggregate spending, but it doesn't stop us as an individual saving. So if we saved, we'd pass the money to a bank, say for a savings deposit, who would then be faced with the expiring money. It's like a hot potato. And so they need to then pass it on to a borrower who would buy something like a car or a house, which would stop the money expiring. And by doing that, you keep spending at a fixed level every month. It can't change.
So talk me through the problems that you see this really addressing and changing.
I really think it would help reduce inequality both on a global level and a national level. On a global level, the problem today is we save a lot of money in rich countries, but we don't have enough investment opportunities, and that's why interest rates are so low. But really, that shouldn't be a problem. Really, we should be sending our savings to countries that do have investment opportunities, like all these emerging economies that have so much potential capital accumulation ahead of them that would make them more productive, more prosperous. And what I think the system I propose would do would end the business cycle and so make people more confident to invest in these countries because they wouldn't lose 60% of their money overnight because of a downturn. The other form of inequality I think would help is on a national level, because today we have business cycles, and business cycles mean that there's a prolonged period of time where unemployment is below the full employment level, and that means the negotiating position of workers is impaired.
Have you considered behavioural economics in this? You know, how people actually would react?
What I love about the system I propose, it acknowledges that people aren't rational, they aren't behaving like neoclassical economists say they do. But it doesn't matter how fearful people are, how greedy they are, demand would be fixed, spending would be fixed. It acknowledges that people don't behave in the way we thought they did, and it works around that.
Thanks for watching. For more videos from the Voice of the Market, please subscribe.